Are your savings earning barely anything? In today's favorable interest rate environment, your money could be working much harder. This video will show you how to choose the best high-yield savings accounts and CDs for 2026 to significantly boost your earnings. If you find this helpful, consider subscribing. We break down finance news like this every week. Drop a comment with your biggest question about savings accounts. Let's dive in. Forget the penny jar. Understanding the difference between traditional savings and high-yield savings accounts, or HYSAs, is crucial. While traditional accounts might offer a fraction of a percent, HYSAs, especially in today's environment where the Federal Reserve has kept rates elevated to combat inflation, can offer over 4% APY. Imagine earning an extra $400 a year on just $10,000. That's the power of making a simple switch to an account designed for growth, not just storage. This is educational content, not financial advice. The current economic landscape presents a unique opportunity for savers. Strategic monetary policy and efforts to manage inflation have led to a favorable interest rate environment, making cash deposits work harder than ever before. This is an opportune moment for individuals to leverage these higher rates to their financial advantage. Consider this. A traditional savings account might offer a meager 0.05% APY. In contrast, high-yield savings accounts, or HYSAs, are currently offering rates upwards of 4.5% APY, according to industry data from June 2026. This means that $10,000 deposited could earn approximately $450 in a HYSA, compared to just $5 in a standard account over 1 year. HYSAs provide accessibility to funds, often with no minimum balance requirements, and FDIC insurance up to $250,000 per depositor, per insured bank. While rates are variable, they generally track market trends. For those seeking guaranteed returns, certificates of deposit, or CDs offer fixed rates for a set term, often exceeding HYSA rates for longer durations. A strategy like CD laddering, where deposits are staggered across different maturity dates, allows for periodic access to funds while capturing potentially higher rates as terms mature. This approach balances growth potential with necessary liquidity. When savings languish in traditional accounts, earning mere fractions of a percent, it's time for a change. The current economic climate, with interest rates offering a more favorable return, presents a prime opportunity to make cash work harder. High-yield savings accounts, or HYSAs, are emerging as a key strategy for this. What exactly is a HYSA? Think of it as a supercharged savings account. They offer significantly higher annual percentage yields, or APYs, compared to standard bank accounts. For instance, a HYSA might offer 4.50% APY, while a traditional savings account could be as low as 0.10% APY, according to data from the FDIC. This difference can mean earning hundreds of dollars more annually on the same deposit. Beyond the attractive interest rates, HYSAs provide crucial liquidity, meaning funds are readily accessible without penalty. They are also FDIC insured up to $250,000 per depositor per insured bank for each account ownership category, offering a vital layer of security. However, HYSA rates can be variable, meaning they can fluctuate with market conditions. Also, many of the best options are found online, which might be a consideration. When choosing, look for accounts with no monthly fees, low or no minimum balance requirements, and straightforward online access. Ultimately, understanding these accounts empowers individuals to make informed decisions. It's about leveraging accessible tools to achieve greater financial well-being. When exploring a high-yield savings account, a few key details can make a significant difference. Consider any minimum balance requirements. Some accounts may ask for a few $1,000s to earn the top annual percentage yield, APY. Does the bank charge monthly maintenance fees or transaction fees? These can eat into earnings, so look for accounts that waive them. How easily can funds be accessed? While HYSAs are designed for saving, knowing if transfers are quick and straightforward, perhaps through a linked checking account, is crucial. What's the customer service like? A quick search reveals customer satisfaction ratings often highlight responsiveness and helpfulness. Think of it like choosing a reliable tool. You want one that performs well and is easy to use. For instance, many top online banks, like Ally Bank or Marcus by Goldman Sachs, often boast no monthly fees and offer competitive APYs that can significantly outpace traditional savings accounts. In fact, as of mid-2026, some are offering rates around 4.50% APY, a substantial jump from just a few years prior. This means every dollar put to work can generate considerably more interest. Understanding these features ensures a smooth experience and maximizes the earning potential of hard-earned money. It's time to make savings work harder. As of June 2026, several online banks are leading the pack with exceptional high-yield savings account rates. Consider these top contenders. Ally Bank, known for its fee-free banking and integrated checking. Discover Bank offers competitive rates and excellent customer service. Capital One 360 provides a user-friendly platform with no minimums. And Marcus by Goldman Sachs rounds out the group with consistently strong APYs. What makes these accounts stand out? They often boast no monthly maintenance fees, minimal or no minimum balance requirements, and seamless online access. For instance, Ally Bank's savings account typically offers a robust APY, far outpacing traditional savings accounts. This makes earning more on emergency funds or short-term goals an easy win. But how do these stack up against each other? Each has unique strengths. Ally often shines with its full-service banking integration. Discover frequently attracts customers with its straightforward, high-yield offerings. Capital One appeals to those valuing simplicity and accessibility. Marcus, from a trusted financial institution, remains a consistent performer in the HYSA space. Remember, these rates are dynamic. However, the current environment, influenced by Federal Reserve policy adjustments to combat inflation, presents a favorable landscape for savers. The average American household could see hundreds, even thousands of dollars in additional interest earnings annually, simply by moving funds from a standard account to one of these leading HYSAs. Interest rates, while generally favorable, are not static. They can and do fluctuate based on economic conditions and Federal Reserve policy. For instance, a projected 4.5% annual percentage yield, APY, on a high-yield savings account today might shift. It's crucial to remember that any rates mentioned are illustrative, reflecting anticipated market trends for 2026. Consider this. Would a slight dip in APY negate the benefit of a compelling sign-up bonus? Many institutions offer these incentives, sometimes providing hundreds of dollars, simply for opening a new account and meeting a minimum deposit threshold. These bonuses can significantly boost initial earnings, acting like an immediate boost to savings. For example, a $200 bonus on a $10,000 deposit is an instant 2% return before any interest accrues. Understanding these nuances is key to maximizing savings. While rates are projections and bonuses are temporary, they represent opportunities to accelerate wealth building. The goal is to leverage both the underlying interest rate environment and any promotional offers to make savings work as efficiently as possible. Certificates of deposit, or CDs, offer a straightforward path to predictable earnings. Unlike high-yield savings accounts, CDs lock in a fixed interest rate for a set term, often providing a slightly higher return. For instance, a one-year CD might offer a 5.25% APY compared to a HYSA's variable 4.85% APY, according to industry data from June 2026. This fixed rate acts as a powerful shield against potential market downturns, ensuring the planned growth of savings. But what's the catch? The primary trade-off with CDs is liquidity. Accessing funds before the maturity date typically incurs a penalty, which can sometimes erase the earned interest. Think of it like a reservation at a popular restaurant. You get a guaranteed spot and price, but leaving early means forfeiting your deposit. However, this doesn't mean sacrificing all access. Many financial institutions offer a range of terms, from short durations like 3 months to longer commitments of 5 years. This variety allows for strategic planning. What if interest rates continue to climb? A strategy known as CD laddering involves dividing funds across CDs with staggered maturity dates, ensuring periodic access to cash while still benefiting from potentially higher future rates. Each CD is protected by FDIC insurance up to $250,000 per depositor per insured bank for each account ownership category, providing a robust safety net for principal and interest. Consider the Certificate of Deposit, or CD, a powerful tool for those seeking predictable growth. Unlike savings accounts, CDs offer a fixed interest rate for a set term, shielding funds from market volatility. This predictability is a significant advantage. For instance, a 5-year CD might currently offer a guaranteed 4.5% annual percentage yield, a rate unlikely to fluctuate. But what if interest rates rise during that term? This is where the CD ladder strategy shines. It's a simple yet effective method to balance guaranteed returns with flexibility. How does it work? Instead of putting all available funds into a single long-term CD, a CD ladder involves dividing the money and investing it across multiple CDs with staggered maturity dates. Imagine dividing $10,000 into 5 equal $2,000 portions. One portion might go into a 1-year CD, another into a 2-year, and so on up to a 5-year CD. When the 1-year CD matures, the principal and interest can be reinvested into a new 5-year CD, extending the ladder. This approach ensures that a portion of the funds becomes accessible regularly, while also allowing the investor to capitalize on potentially higher interest rates offered on new CDs as older ones mature. It's like having a series of mini paydays, all while keeping the bulk of the money working harder for longer.